president of Heron Financial Group. That's a wealth advisory firm I started over 20 years ago after I graduated from business school. At present, we take care of the financial lives of 90 families, about $100 million in assets. And obviously, the number one goal of our clients is to enjoy their retirement, not just to retire, but enjoy their retirement. So before I get to my presentation, I just want to do a little bit of a head count here. Show of hands, who is already retired? So, okay, it's about 8 people. Who is between 0 and 10 years from retirement? That's about 10 people. And who is 10 years or more out? All right, so we have about a third already retired, a third 10 years out, and then the remainder are still more than 10 years out. Okay, so we like to use a lot of colorful analogies when we talk to our clients because we're always talking about esoteric thought questions. So we often use the analogy of an aircraft landing to describe how people should think about investing for their retirement. Why would we do that? Any thoughts out there?
Be bumpy.
It's bumpy, right? If you get it wrong, the results could be disastrous. Now, up until 20 years ago, most Americans got to be passengers when they landed for their retirement because they worked for a company which provided a pension plan. They would collect Social Security. Maybe they even got health care benefits. So really, there was not a lot of thought about how they were going to manage their financial affairs after they retired. They knew in advance what it was going to be like. And let's say, from 1980 on, corporations switched from defined benefit plans, which are pensions, to defined contribution plans, which are 401ks. And what that means is you work for a corporation your whole life, and then at age 65, you have a lump sum of money and potentially no knowledge whatsoever of how to manage that money. So it's almost like you've been flying along in a plane, and then 5 miles out, the pilot says, okay, you land the plane. So do you think that would be a good outcome for most people? All right. So we, in our work, spend a lot of time talking to our clients, preferably 20 years out, certainly 10 years out, for God's sakes, right before they retire, about checklists of things they should be thinking about before they land. This happens to be a Cessna checklist, right? And if you look over here, you see a couple things. 1, adjust the fuel mix for the low altitude, max power. 2, extend your flaps, right? That gives maximum lift when a plane is close to the ground. But most importantly, put the landing gear down, all right? Most pilots use a checklist, whether it's a small Cessna, whether it's a B-1 bomber, they use a checklist. They have it strapped to their thigh or in a folder next to their panel there. But we always know the pilots that don't necessarily use checklists because about 100 planes a year land with the landing gear still in the upright position. All right, so I'm not gonna do an exhaustive checklist of everything that could possibly matter to your retirement. But we're gonna do 5 items briefly, and then I have some resources for you to look at in more detail. So, number 1 on the checklist: when to collect Social Security. How many people in this room have pulled their Social Security statement recently? I got 1, 2, 3, 4, 5. Okay. So that's 5 out of 50 have looked at their Social Security statement. The rest of you, when you get back home on Monday, go to ssa.gov/mystatement and pull a statement, and it will tell you a couple things. 1, it will show you your lifetime earnings, and you might be impressed about how much money you've made over time. But 2, it will show you what your Social Security benefits will be at age 62, age 65, and age 70. And we tell clients that as much as possible, we want them to draw those benefits starting at age 70, because you get 50% more money at age 70 versus age 62. Now, if you happen to know that everyone in your family dies at 70, well then forget it, go for 62. But we expect most of our clients to live at least 5 years longer than their parents, which means that we expect most people to live to 90 or 95 years old. And when you're in your 80s and 90s and you're getting double the payments that you would have gotten if you started at 62, that can make a pretty big difference. So, number 1, check your Social Security statement, see what your situation is, think about drawing at 70 rather than 62. Anybody know what a sustainable draw rate is? Draw rate is the amount of money you can take out of a portfolio without running it down to zero. And in the current low interest rate environment, low stock growth environment, 4% is the conservative draw rate. If you have $1 million, you can draw $40,000 a year and not worry about running out of money. You can actually go as aggressively as 6% a year and still not run out of money. But we're a little anxious about that. If you go above a 6% draw rate, there's a good chance you're going to run your portfolio down to zero before you die. All right? So we have some sophisticated modeling software so we can show clients, 4% draw rate, 6% draw rate, 8% draw rate. This is what's likely to happen to you over the rest of your life. Checklist item 2, prepare a retirement income statement. We talked about Social Security. Some people still get pension benefits. We talked about sustainable draw rates. So 10 years out, look at your Social Security statement. Say, hey, I'm going to get 30 grand a year. Call your HR department and learn you're going to get 24 grand a year from a pension. Look at the assets you have on board. It's $1 million. That's 40 to 60 grand a year. Add that all together, 94,000 to 114,000 a year. Is that comfortable? How do you know it's comfortable? If it's about 100% of your current income, you're on the right track. If the number is significantly lower than your current income, you need to make some decisions. You need to save more, or sell an asset like a second home, or a business, or plan to spend less in retirement. But it's good to know 10 years out what your situation is likely to be. Checklist item 2. Asset allocation. We talked about adjusting the fuel mix, right? Anybody even know what asset allocation is? We got a couple of hands. We got 1 hand, 2 hands, 3 hands. Okay. So asset allocation is the mix between equities, fixed income, and cash. And then within equities, the percentage allocated to domestic stocks, international stocks, emerging market stocks, and commodities. We recommend for our clients in retirement 60 to 70% equities. That seems like a high number. We've got a reaction here. 25 to 35% in fixed income, and 0 to 5% in cash. No asset class is risk-free, but the mix hedges the different risks. For example, stocks are volatile. We know they can fall 45% in 6 months. We saw that in 2009. Fixed income has risks of not keeping up with inflation, not yielding enough. All right? So we want to see our clients starting at heavily invested in equities in their 30s and 40s, and adjust that asset allocation mix down in risk assets and up in bonds as they get close to retirement, but not go so far that they can't actually make enough income.
Excuse me, David.
Mm-hmm.
That checklist number 3 you said is for people in retirement?
Yeah, by the time you get to that actual retirement day, we'd like to see your portfolio 60 to 70% in equities and 25 to 35% in bonds.
And is that regardless of age?
Well, the reason why there's a range here is because we're going to make adjustments, right? Some people are feel more comfortable with risk. They feel more comfortable with volatility, right? They'd rather get the higher returns of a 70% stock portfolio. Other clients are risk adverse. They don't like volatility. They'd rather take 35 or 40% in fixed income and accept a lower draw rate. Okay, so we have that conversation, the pros and cons of these different asset allocations. And then once you actually have to depend on your portfolio, right? How do you actually accomplish that? What's the mechanism? We talked about the old days when you got a pension and you got a check every month, right? Well, now we have to replace that monthly check. So we have a strategy that we call the 3-bucket retirement income strategy, where a client's assets will typically be 60 to 70% in risk assets. That's the stocks, that's the commodities, that's the volatile stuff that happens to be high return. A couple times a year, we'll transfer the excess of this bucket, right, if it gets up to 75%, let's say, into the bond bucket. Lower return, lower volatility. The excess of that gets poured into the cash bucket. Almost no return because it's mostly in money markets, but no volatility. And the client gets the exact same monthly draw regardless of what's happening in the overall markets. And we had a pretty good test of this back in 2008, 2009. The risk asset bucket probably fell to 40% of the assets. Well, we don't go back up the waterfall. We simply continue to pay at the monthly draw out of the cash bucket and reload it from the bond bucket, knowing that we have a year's worth of return here and 4 years worth of return here, we can survive a 5-year drought in risk assets and wait for that market to recover and still pay that monthly draw, which is exactly what happened for our current clients. Another question that comes up, Dave, I've got both taxable assets, a joint account, a trust account, and IRA assets. Where do I go first for my money, right? We tell clients to hold off on drawing on those IRA accounts as long as possible. Let tax-deferred growth occur as long as possible. At age 70 and a half, you have to start taking money out of a conventional IRA. That's not true with a Roth IRA. We'll get into that some other time. But then the other issue is that people don't realize that when you draw money from an IRA account, it's taxed at your income rate, period. There's no provision for capital gains that might have occurred in that account over time. Whereas your taxable accounts, the draw rate could be, the tax rate could be 0 if there's no capital gain, or it could be 15% if there's a capital gain, or it could be 30% if it's an income distribution. Generally speaking, the money coming out of your taxable accounts has a lower tax burden. So we want to draw money from those accounts first, if necessary, exhausting them, and only go to the tax-deferred accounts when we have to. Now, I just covered in 15 minutes material that I could talk about for days. I'm not going to go into too much further detail, but we did create a series of primers at my firm that gets into this in detail. First off, different phases of it. Planning, investing for retirement, right? When you're still 10 to 20 years out. Planning when you're now 10 to 0 years out, and then once you're actually retired. And that ends my presentation. So let's talk about history. There was a time when advisors were supposed to be very prudent and have 100% fixed income portfolios for, let's say, a pension plan or let's say someone's retirement. And they got crucified in the 70s when interest rates and inflation soared. Not only did the value of those bonds fall sharply, but also the real after-tax income of those bonds fell sharply. So there was a revolution in how the Hamilton College Endowment looks at its future, or I look at my client's retirement. We need to cover those different risks. Stocks clearly are volatile. They can fall 45% in 6 months. We know that. But they also have a built-in inflation hedge. If inflation picks up, General Electric will increase the prices it charges for locomotives and thereby increase its dividend. And they continue to grow over time. Particularly in the current environment where bonds are extremely highly valued, offer extremely low yields. They're still slightly positive because inflation is low. But if you went to a 50% bond portfolio right now, you would have to accept a 3% draw rate for the next 30, 40 years, not a 4% or 6% draw rate. So we had that conversation with our clients. How old were your parents when they died? And oftentimes they say, well, they're still alive. But sometimes they both died at age 50. Well, then we got to kind of think a little bit about whether 62 versus 70 makes sense. But I would say for 95% of my clients, waiting till 69 or 70 to start taking Social Security is the right way to go.
Yeah.
A lot of what we discuss with our clients is liquidity risk. And so for our clients, we will invest in a full gamut of investments that starts at cash and goes up through international stocks and commodity funds. But we won't invest on behalf of our clients in privately held real estate, privately held businesses, things like hedge funds or private equity or venture capital that are illiquid and non-transparent. They certainly can make that investment on their own, and we will certainly take that cash flow into account. For example, if you happen to own, you sell your business, but you retain the property and the new owner pays you rent, yeah, we'll add that into your income stream.